Hey folks, it's Austin at Homeowners Financial. And look, I get all these requests to share our buyer workshops online. So this is what we're going to do, right? This first one I'm going to break into three parts. This is called the ABCs of lending. So let me go ahead and share the screen so we can get things kind of moving here. But the whole idea is that you're informed, that you know what's going on, right? I want you to have knowledge so you can understand the process. You can make the best decision for yourself and your family's future and just feel secure in your home. So this is the ABCs of lending, right? This is your life. This is your options. This is for your success. And overall, this course, we're going to cover about three things. We're going to cover loan types, program types, transaction types. We're going to cover the 4 quadrants of qualification. And then we're going to go over rules of thumb and tips and tricks. Ooh, that's a lot of T's. A lot of T's. But we're going to focus on this first one, right? So let's talk about loan structures and terms, right? And think about loans like biology, right? Just like that, there's ranks, right? And the way that you qualify depends on the program type, as well as the structure of the loan, as well as your individual life. So there's 3 different things we're always running through. If this change, if this change, if this change, right? So just think about how they kind of flow together. So first of all, let's talk about loan types. Loan types are either conventional or government. Conventional loans means they are not government loans. Government loans, they have an A at the end, right? USDA, VA, FHA, these are loans that are insured by the federal government. And then we have program types, fixed rates, adjustable rates, they qualify differently, purchase types, refinance types, these are transactions, right? And so really then there's your life and how you fit within each one of them. So at the base, loans are either conventional or government. Again, I said government loans, they have that A in the end. These are insured by the federal government. They don't own it, right? So I had a client that looked up VA guidelines and sent them back. I'm like, cool, but the VA doesn't own your loan. They're saying how they will insure the loan. Your loan, you still have to qualify with income. You still have to qualify with assets, right? It's not a pick and choose. And conventional loans are loans that are not insured by the federal government. You hear of MI, mortgage insurance, or PMI, private mortgage insurance, right? These are Fannie Mae, these are Freddie Mac, these are banks, these are hedge funds, these don't have a guarantee, I should say, that the lender will get their money back if you fail to repay the loan. Yes, there's mortgage insurance on some, but if you're doing 20% down on $1 million house, there is no mortgage insurance, right? So they're a general higher risk than these government loans that are indeed insured by the federal government. So if you default, they will pay it back. Then let's talk about the types of loan, the program types, right? They're either fixed rates or they're adjustable rates. Now, fixed means it's never going to change. It's going to be the same thing forever, right? It's going to be the same payment over time. Your mortgage is fixed. Adjustable are also called ARMs, and ARM stands for adjustable rate mortgage, right? Like, get some ARMs out there. And these are terms that can change over the life of the loan, right? So fixed period ARMs are typically what you think of when you hear of a 3-1, a 5-1, a 2-1, right? So a 5-1, just as an example, is a loan that's fixed for 5 years and adjusts once a year thereafter. Now they have caps on these, right? They have limits, how much change can occur, right? So a 525 cap means that it's fixed for 5 years and then it can adjust once a year thereafter, but it can change 5% in that first adjustment period. It can change 2% thereafter, but only 5% for the life of the loan. So let's make the math easy. Let's say you started with a rate of 4%, right? And now it's been 5 years and it changes, and there's a margin and an index. The index is literally what changes. The margin is not. But you add those together to get your rate. So let's say your index well, let's not use the index. Let's just say your index is 2. It's changed to 2, and your margin is 2.5. So the 2.5 and the 2 equal together 4.5. Well, you started at 4, so now your rate's 4.5. It could never change above and below 5%. So if your margin's 2.5 and your index is 7, that equals 9.5. Tough luck, there was that 5% gap. That's a lot. So let's just keep moving on. Also talking about adjustable rate mortgages, there are fully adjustable loans. We think of these as HELOCs, of lines of credit, right? Think of it like a credit card in your house, right? And so there's still a lifetime cap, but usually there's not necessarily an adjustment cap. They can change monthly. They don't really change more than once a month, but they can change monthly. So if you hear the Fed is changing rates, they're changing prime. they're changing these line of credit rates. Those are fixed rates and adjustable rates. So let's keep moving down the adjustable rate world. They also have a floor and a ceiling. Again, in my example where we had a 5-1 arm and we had a 2.5 margin and our index was 2, right? We have a floor, which is typically the lowest it can ever go. And that means that that floor is typically also the margin. The ceiling, again, is the highest the rate could ever go, right? So think of lines of credit. Pivoting to that, most of those have an 18% cap. So if prime is at 3.25, well, gosh, you'd really have to change a lot to get to that 18%. So I'm not going to go over too many of these examples. They're here in the slide if you want to come back and review them. If you want to do some crazy math, let me know. We literally have worksheets. We train the team annually on these because as guidelines change, we want to be ahead of it. So let's start talking about transaction types. Loans are either a purchase or a refinance transaction. And if you don't own the property, it's a purchase, right? Now purchases, then the subset there are either it's arm's length, right? Like I don't know you, we can't touch, or non-arm's length, where think about it, where you can hug, where you already have a relationship with the seller. Maybe they're your landlord, maybe they're an old friend, like whatever, right? But if you do own the property, it's a refinance. It's not a purchase. You already own it. You cannot purchase it again. It's a refinance. And these refinances are either rate and term, which is just refinancing the amount you owe on the property, or cash out, where you're taking money in hand as well. Now, different investors like qualify these different. It could be cash out if you had a first and a second mortgage and the second wasn't used to purchase and you're combining the two, that's considered cash out, right? So there's a lot of different nuances. But typically, if you're just refinancing the amount that you do on a first mortgage, it's considered a rate and term transaction. So when we're talking about these, I want you to be informed. I want you to have all these different nuances so you understand. The next thing that we'll start breaking out is the quadrants of qualification. If there's any questions or anything I can do to help, please let me know. It's Austin at Homeowners Financial. Make it a great day.